Good Wednesday morning, Market Chameleons and everyone joining for the first time. Thanks for checking out the Market Chameleon pre-market show. And there he is, all the way from Philadelphia, Dimitri Parkamonik. How you doing, D?
Good morning, Will. How are you?
Good. I didn't have the disclaimer up. I apologize about that. Let me grab it. There you go.
Yeah, good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your broker or call your registered investment advisor. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. Just fix my mic real quick. Does that sound okay, Will?
Yeah, sounds good.
Okay. So I'm going to share my screen real quick. And we'll start out looking at the pre-market report. If you guys have any questions regarding Market Chameleon tools, data analytics, strategies, put those questions into the live chat. Will's looking at them. He'll read them back to me. If you want to come on a show and ask your question live or talk about a strategy you might be doing, we put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, you can click on raise your hand. You don't have to turn on your video camera, but then you'll be able to ask your question live. So while we're waiting for questions to come in, Will, I'll start out with the pre-market report. And then if we don't have any questions, I'm going to continue on the option blocks trade screener that we were looking at yesterday. I set up a couple screens there and did some filters, kind of went over the logic behind the filters and why we're narrowing down potential candidates to look for, I think it was buying call opportunities. So I'll do one for puts today and just basically kind of go over each filter and the logic or the idea behind the filter.
Perfect.
Okay. So let's start out first on a pre-market report, and these are stocks trading in a pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see here we got 46 stocks on our percentage gainers list, 57 on our percentage decliners. So from that perspective right now, slightly bearish bias at the open. I'm going to filter out this list by the S&P 500 stocks. So we're going to take out ETFs, closed-end funds, small cap stocks, anything that's not part of the S&P 500. And this way we can focus on what's going on in the S&P 500 stocks. To do that, I'm going to take this filter in ETF. I'm going to drop it down and I'm going to select SPY, which is the S&P 500 ETF. Now this list is filtered by holdings in SPY. I see two. Made our percentage gainers list, 8 on the percentage decliners. Not a big list, but a little bit more bearish bias at the open. So no questions here, Will. I'll probably move on to that option block trade screener.
Perfect.
And kind of start there. So I'm coming up here under screeners, and here to the left-hand side, option block trades. And this whole list here right now, you can see 202,583 different options that traded. So these are actual trades from yesterday. We're not open yet, this pre-market. These are trades from yesterday that met the minimum criteria that the trade had to be $10,000 in notional value. So we defined that already as an option block. So this doesn't include any smaller trades than that. And a lot of people look at these option blocks for trade ideas or just to know what's going on or look for something very unusual. You could look for spread, multi-leg trades that are very, very high notional or volume. You could look at individual options. So either trade ideas, or really just to get, we have people who they only use this feature out of the website, and they're very used to it. They have their own presets saved, and this is how they kind of learn what's going on in the market. If there's anything in particular unusual or something shifting, that points them to where to start looking. And yesterday what I did was just kind of start setting up some filters to show you guys, like, how to narrow down potential candidates. And let's say, so the premise from yesterday was that, we're seeing a lot of uncertainty in the market because of inflation. With interest rates rising, we don't know where the Fed will stop, how high they have to go. We're seeing China, a lot of issues there. That's the second biggest economy in the world. And then we're seeing the conflict in Russia and Ukraine, and in Europe getting dragged into it. So then you got really the third biggest economy in the world. So all this is creating a lot of uncertainties, and I think that lots of stocks are going to get repriced. It's going to cause volatility. I think volatility is going to persist until these things start going away. And if we think volatility will persist, then are there opportunities to buy options, right? Because when you're buying options, you're buying volatility. Are there opportunities to find potentially good options to buy, right? Or good, maybe cheap enough volatility to buy. So we kind of started out yesterday with the calls, just looking for calls. I'm going to see if we could find some puts, and then go through the logic behind some of the filters I set. And these are starting points, so you guys could use your own ideas, your own filters. I'm just kind of showing you ideas as a starting point. So I created these in this drop down. So these you guys could go and look at them. And I think we went over the call opportunity with Edge. So here's a put opportunity with Edge. So if you click on it, what it will do is populate the filters that I set. So you see these in orange. Those are the filters that I set. And it narrowed down this list, and you could see it only found one actually that fit all the criteria that I put in. All right. And that was from over 202,000 options that traded yesterday. So let's go over some of the logic here. And if you guys have any questions or you hear any questions, well, you stop me. And if you want to, you could do this yourself and then change some of the filters or parameters, that may meet your criteria.
Yeah. So we did have a quick question from Lauren, and I'm not exactly sure. Maybe when I read it to you, you'll have a sense of what he's asking about. He says, wouldn't it make sense to have the bid-ask spread shown as a percentage rather than a dollar figure?
Yeah, I mean, I think you can, but what would you make it as a percentage of, right? Like, so what would when you're making it as a percent, right? Is it like over here, right? Here's the bid-ask spread, so that's 60 cents, right? So is it 60 cents as a percentage of the option price, or is it 60 cents as a percentage of the stock price? Because what if you have an options that's no bid at a penny, right? Or what would you make the percent? So that's one way. You could do both. I hear what you're saying, with it. But I guess you'd have to ask, like lower priced options, higher priced options, because obviously you could have an option that's a penny, 2 pennies, right? So even though it's a penny wide, it's a very cheap option. So what
Yeah,
would you do?
Lawrence is saying his the math behind his would be ask minus bid divided by ask.
Divided by the ask.
Yeah,
Okay,
which is a good
do
thought process for sure.
Yeah, it's a good thought process. Again, so then you're going to have the cheap options, right? That are going to look like big percentage, like a no bid at a penny. So you're going to get a lot of those, right? If you were looking for big spreads.
Yeah. And listen, we may be old school, but you know, the bid in the market was always, you know, the width was always in, you know, cents or dollars, right? That's how it was.
Yeah, it was always censored dollars, and you know, I think that if you look at the rules on the exchanges, I got to take a look at them, but I think there are different requirements that for different option prices, right? So sometimes they'll let them go as much as a quarter, sometimes a half a dollar or a dollar. I have to take a look, but depending on the option price, but also depending on the stock price, because if you have an option that's like, let's say $4.50, $5, that's a 50-cent wide option, $5, you know, whatever, off 10%. But that makes a big difference if the stock price is, let's say, $10, right? Or if the stock price, let's say you have an at the money, right? The stock price is $10, or if the option or the stock price is like whatever, the Google or Amazon 2,000, right? So for a stock price that's 2,000 and the stock itself is maybe $2 wide, that spread is not as unreasonable as if the stock is like $10, right? And in a $10 stock that's a penny wide. So it is a relative, you know, maybe I'll try to find some examples, but there are other things that you wanted to take into consideration, especially like what is the stock price and how wide is the stock price itself, and are the options, you know, really more liquid or less liquid than the underlying.
Perfect.
Okay, so but let's get back to it's a good question. I hear. Let me think. I'll think about it. I'll think about how to, you know, create a metric for that. So here we filtered out. We use this my presets that I created just to get started, and really that wanted to kind of just go through the thought process. So here I just set the first one as a put because the screen is for put option, and I'm looking for trades, for trade ideas. So I do want to see something that traded. You know, I'm not that there was an actual trade. Somebody thought it was a good purchase. Somebody thought it was a good sale. So I wanted to take a look at it, you know, at it further. And here I set that because I'm going from the buy side, I'm looking at an expiration that's further away. And so I set it at 30 days or more here. And you guys could change it. The reason I'm doing it is the following, that the further you go out in time, you know, the less information disadvantage you have over others. So somebody may know something, you know, may have done their homework, and in the shorter term, there is more information out there that you don't have that could put you at a disadvantage. You know, somebody's selling an option, most likely, you know, somebody's selling an option. It's not, you don't know for sure that nothing's going to happen between now and, let's say, 30 days from now. Anything could happen, right? Like the further you go out, the more chance that something could happen that you don't know about. But in the shorter period of time, when somebody sells an option, they're really just trying to collect premium, like nothing's going to happen. The best scenario is the stock doesn't move, the option decays and keep all the premium, right? And there are certain information that might even help. There are people who see limit order books that you don't see because they're paying for it. They're proprietary, feeds from exchanges. And if the limit order book is getting thicker and thicker and thicker, maybe volatility will come in if it's getting thicker from both sides. So I set this to go out further because I think unless I really know this stock and I have very good information, my information disadvantage over time, it evens out. Like I don't have as much information disadvantage over time from the buy side. I also set this trade condition, this next one, because options, right? You could have a single option trades either a call or a put, but you could also have multi-legs like spreads, straddles, or you could have stock contingent where an option is tied to a stock. So to make it easier, I just looked for certain types of trade conditions. One is auto execution over here, intermarket sweep or regular trade. So all three, we created a filter for all three. So that's what I'm filtering. This way, I'm not trying to figure out in this scan, was it a call spread or a put spread or a straddle or a strangle? I'm just looking at that the trade condition that was reported was either an auto execution, intermarket sweep, or a regular trade, which means that, there's no, according to the exchange, at the time of the trade, there wasn't anything tied to it with another option or stock as a condition of that trade. Okay. I said this, it's arbitrary, but when I looked at it, I'm like, I want to buy an option, but let me try to find something that is under $2. So my first thought is like maybe looking for something cheap. So I sent it under $2, but you could change it, you could do any or under $5. So if I change that under $5, you could see here a lot more filled up. Right. But let's just keep it under 2 for now. All right. So this trade, you can see it traded for $1.70 under $2. This one, the dollar notional of the trade, it's above 10,000. That's the default. They have to be at least above 10. You could change it here, but I just left it at the default. So you could see here, 80 contracts traded $1.70. The notional value is 13,600. Okay. Bid ask spread, I put over 25. Okay. Now, the reason I'm doing it is that I want to see, before I do that, here, I forgot this, trade side NBBO. And here I put that the trade itself either hit the bid or traded below the bid for an intermarket sweep. And the reason I wanted to do this is I wanted to scan for where I thought there was a sale, an incoming order that was a sale to a dealer. Okay, so most likely, the order that came into the exchange sold on the bid or below, and the dealer was on the buy side. So that's my interest right now, because I kind of want to see if I could get on the same side as the dealer. And why I'm looking at it, so we could see this trade happened at $1.70. The bid was $1.70. Ask was $2.30. So I'm looking at it because a dealer was willing to buy it at that price. And it looks to me like the dealer was making a significant amount of edge based on that market. Because if we just took the market alone, $1.70, $2.30, we could see that bid ask spread, right, is 60 cents. So theoretically, the dealer made 30 cents edge, because if we say that the midpoint is fair value, that's the fair market value, the dealer kind of made 30 cents edge by buying. Okay. And think of it like this: what's a dealer? A dealer, it's a market maker, specialist. They act kind of like a car dealer, right? A car dealer has a price he's willing to buy cars and a price he's willing to sell cars. And the difference would be the spread, right? That's the profit margin.
AD?
And yep.
In your comment on dealer, that was the one question that was outstanding. You asked me if there was an outstanding question. Yesterday, someone asked about the number of dealers.
Yes. So I don't know. I don't know the exact number of dealers. You might be able to go. There might be different ones by exchange and by the stock and option. There used to be a lot more. Now there's a lot less because once the exchanges went for profit, we used to be a market maker, right? So we used to be a dealer. But as the exchanges became for profit, they changed their model, and now there's much fewer and fewer dealers. I think even Gary Gensler mentioned it. Like there's a lot less liquidity providers that are regulated and acting in the role of a market maker. So I don't know, it could fluctuate more, could come in less, but the bigger ones you probably know, like Citadel, Susquehanna, Goldman Sachs. I don't know, Citigroup might be doing it. So there's a couple big ones like that. Is Wolverine still there? Well,
yeah,
maybe Wolverine. So there. I don't know exactly. There used to be a lot. Now there's not that many. But you could probably find it out by going to the different exchanges. You might be able to test.
Well, I just did a quick search online, and I know it's wrong because it says that there used to be 60 broker dealers, and now there are only 5 to 15. So I know there were way more than 60.
There were way more than 60, but the 5 to 15 maybe correct. And a lot of them or dealers are basically at this point plugged into they're internalizing, right? They're plugged into the payment for order flow system. So they're just buying it from, they're going out and buying Robinhood trades and so forth, and they control the pipes as well. But let's just to save time. If there are more follow-up questions, we could talk about dealers. But let's just to save time and finish up this scan. We'll move on. So the idea is, I wanted to see what
AD.
Yep.
You may want to adjust your mic. It just sounded like you went into the deep sea.
Under.
Now it's good now. It's good now.
Okay.
Perfect.
So here I see, okay, here's a dealer bought it at $1.70, most likely, it's a dealer bought it at $1.70. And my thought process is maybe, I didn't get on that trade, but there might be more, right? That comes in. So, I might try to put in a bid, $1.70, $1.71, if I think it's a good purchase, right? To see, because sometimes somebody sells in, comes back, sells more, right? So there might be a chance that they have more to sell, and that might be an opportunity for me to go in there and try to get in on the same side as the dealer. So the thought process here is I want to see what's trading, and maybe there are trades coming in that I might be able to get in on the same side as a dealer if another trade comes in, right? So I would be trying to do it at this price, maybe better it a little bit. Maybe if I think it's a very good purchase, and I think that the fair value is $2, maybe putting in a bid for $1.75 and entice, and that will motivate the seller to sell me, my allotment. So that's why I'm looking at bid and below. The other thing is, if I want to be on the same side as a dealer, right, then I actually want the bid-ask spread to be wider because I'm trying to provide liquidity. So I'm not trying to take the liquidity. I'm actually trying to provide the liquidity. And if I'm providing the liquidity, I want to get rewarded for it, right? So to get rewarded for it, if they hit me on a wider spread, that's actually they're paying me to take the other side of the you're acting like the dealer, right? Like pretend you're a car dealer and you're saying, I don't want to buy from the dealership. I want to buy at the same price he's buying it at, right? So the wider that spread, right, that means you're getting a better deal on that buy side. Does that make sense to people? Let me know. So this is a little bit different. I'm not trying to take liquidity. I'm scanning this for potentially providing liquidity and get rewarded for something that I think could be a good purchase. Okay. So that's why I'm looking for a wider spread. Okay. Now the other thing, so we kind of defined a couple points of advantages or edge, right? We're looking at, we eliminated kind of the very short-term informational edge by scanning for options that are longer out. We're looking for something where we see that a dealer is potentially buying something, and we think that the dealer themselves have more information than we do because they do see the order book, the order flow, and they're willing to buy it at that price. So we think that that could be a good price. And we're also looking for a reward for providing liquidity because that bid-ask spread is wide. Okay, so those are a couple things that are part of this scan. The other thing we want to see is, well, is this premium a good premium, right? And one way we could test it out quickly is to say, if we plugged it in, because we want volatility. Remember, we were trying to buy volatility. If we took this stock's volatility, FHN, and we took its 20-day volatility, it's historical, it's the stock's historical 20-day volatility, plugged it into the option pricing model, Black-Scholes, binomial, what do we think the option's worth? And in this instance, using 20-day volatility, it's worth $1.80. What if we used its 1 year long-term volatility? Well, then this option would be worth $2.50. And if we just took the average between the 20-day and the 1 year, this option would be worth $2.15. So you could see that the trade price of $1.70 is below these theoretical values. So theoretically, based from the Black-Scholes model using the stock's own historical volatility, $1.70 still seems to be a pretty good deal from a volatility standpoint. Okay, and to do that, I set these filters here. What is the price? The price of the option versus the option, what the theoretical value would be of that option using a 1 year historical vol. So it's 250, and you could see $1.70 is below 250. So I set that as any theo below. And then then measuring the price of the trade versus the average historical theoretical value. So it's the average of 20-day and 1 year. And I set as anything below. So $1.70 is below 215. So from that perspective, that also looks like a pretty good deal, that the premium here looks like, it's selling at a discount, and potentially that premium could be higher, right? Or it could trade, or should, if it was mean reverting, be at a higher level. So that quickly is another example of a starting point. You could go search. There could be things that, are particularly happening with the stock that might say this is still not a good deal. If there's a cash takeover or something going on, you still have to investigate it. But this is just to narrow down potential candidates. Okay. So it's not to just go in there and blindly do it, but to just narrow down potential candidates that meet certain criteria. So hopefully that was helpful. We're right up at 9:30, Will. I'm going to let everybody go.
That was great, D. Just a quick question. When we were on the Amex, how many market makers and how many people had seats? Do you remember?
I feel like it was in like hundreds and hundreds, like 800.
Yeah, I thought it was over 500. But I was
yeah.
The community is interested on the number of dealers. I actually did a quick search on the NYSE ARCA website for their options and stock business, and there's 70 listed today on a Excel file. So it is, and we were just one exchange, the American Stock Exchange. Philadelphia Stock Exchange had market makers, the CBOE had market makers, the PCoast. So it's the number of dealers who actually make markets in the options are considerably less by, probably not. I would say at least 90% less, maybe 95% less. The numbers.
Yeah, than there used to be. Yeah, and that could be a potential problem when volatility increases. Because the less market makers you have, and if they end up having a lot of concentrated risk all on one side, that could be a problem too.
Yeah, for sure. All right, D, great job. We will see you tomorrow, everyone. Thanks so much, buddy.
Thanks everyone for joining. Stay safe out there. Have a great trade.